Welcome to Insightful Value, where we uncover undervalued companies that may be flying under most investors' radar. Today we're focusing on Community Healthcare Trust, which has seen its stock price fall notably. Could this dip represent a hidden income opportunity or signal deeper issues? This review is for informational and educational purposes only and should not be considered financial advice. If you like concise and clear analysis without jargon, hit that like button and subscribe to our channel for more. Community Healthcare Trust is a real estate investment trust specializing in outpatient healthcare properties across the United States, such as behavioral facilities, rehabilitation centers, and medical office buildings, owning roughly 200 properties totaling about 4.5 million square feet and valued at over $1.2 billion. From a value analysis perspective, it traditionally appealed to income-focused investors due to its attractive dividend yield and healthcare exposure. In the second quarter of 2025, the company reported a net loss of $12.6 million, or $0.50 per diluted share, but produced adjusted funds from operations of $0.50 per share. Revenue rose about 5.7% year-over-year to $29.1 million, yet missed consensus by roughly 4%. Key issues included an $8.7 million credit loss reserve tied to a geriatric behavioral hospital tenant facing financial distress, plus a $1.7 million reserve on interest receivables. Executive severance charges of $5.9 million also weighed heavily, reducing core funds from operations by around $0.22 per share. Despite the headwinds, CHCT declared a quarterly dividend of $0.4725 per share for over a decade, signaling management's confidence in cash flow. Margins are compressed, and FFO more than halved year-over-year due to these one-time charges and tenant-specific risk. Earnings forecasts have been revised downward by analysts, and valuation models suggest the stock may be trading above its intrinsic value. Some models peg fair value significantly below current levels, driven by pessimism around future dividend sustainability and rising debt ratios. As for risks, the exposure to a few large tenants, especially one troubled facility, raises collection and lease renewal uncertainty. Credit loss provisions are growing, and executive transition expenses point to possible instability. Debt-to-equity levels are elevated relative to peers, and growth depends heavily on acquisitions and capital raising. Why might investors consider Community Healthcare Trust now? Attractive dividend yield at around 11% and continued AFO coverage suggest income support. The pipeline of acquisitions, over $146 million under agreements, with expected yields between 9.1 and 9.75%, indicates a commitment to growth, and the healthcare property niche can be defensive in volatile markets. Conversely, why might investors wait or avoid? Uncertainty around the tenant issue could delay repayment or lease renewals. FFO volatility and high payout ratios relative to earnings raise sustainability questions. Valuations appear rich by several analytical models, and the real estate sector remains sensitive to credit risk and interest rate swings. Looking ahead, recovery chances depend on resolution of tenant disputes, stronger FFO execution without one-time charges, successful capital deployment on acquisitions, and margin recovery. If those metrics rebound, sentiment could improve and valuation could rebound, but execution risks remain real. Insightful Value delivers in-depth analysis of undervalued companies, translating key data into actionable insights without the confusing jargon. We help both new investors and experienced analysts understand what truly matters behind the numbers. For more on Community Healthcare Trust and other under-the-radar opportunities, visit InsightfulValue.com. Thanks for watching. Don't forget to subscribe to our channel and like this video for more insightful breakdowns.